Good morning, everybody. This is the meeting of the Investment Committee of the California State Teachers Retirement Board. We look forward to your participation today. We have an interesting agenda. If you could take the roll, please.
Controller Yee.
Here.
Superintendent Thurman.
Here.
Ms. Yamamoto.
Here.
Mr. Tang.
Here.
Ms. Hendricks.
Here.
Mr. Keeley.
Here.
Ms. Bradford.
Here.
Ms. Erden.
Here.
Mr. Gunning.
Here.
For the State Treasurer, Mr. Ruffino.
Here.
And for the Director of Finance, Ms. Miller.
Here.
Mr. Chair, you have a quorum.
Thank you very much. The first item of business is...
Mr. Chair, I have a brief statement to read.
Oh, that's right. I apologize.
Thank
I
you.
always miss that one.
Okay, so the CalSTRS board meetings are live web streamed, video archive, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of each agenda item that the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there's not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. And to protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared. And since the September Teachers Retirement Board meeting, CalSTRS received 17 emails requesting divestment from Enbridge, 2 emails requesting divestment from fossil fuels, 5 emails from members opposing the net zero pledge, and 1 email from a member concerned about climate change.
Thank you. The first item of business is the approval of the committee agenda. I would just note I would like to have a little bit of flexibility on the agenda items as we move forward. Do I have a motion with that?
So move.
Second.
All in favor?
Aye.
Thank you very much.
Well, you got to be opposed, right?
Any opposed? I didn't hear any voices.
Okay, good.
Thanks. I always have Karen here to help me. I mean, she is my teacher today. The first item that we take up is the opportunities for statements from the public. Is there anyone in the public that would like to address us today?
Yes. We have a couple people for public comment right now. So if we can, we have the timer up. Our first speaker will be Oscar.
Good morning, Oscar.
Good morning. Thank you, Investment Committee Chair Prezant and other members of the committee. My name is Oscar Cordaro, and I'm a pet care specialist at a PetSmart in Casa Grande, Arizona. I'm a member of United for Respect, and PetSmart workers have been communicating with CalSTRS for over a year.
Wait a minute.
Hold on. We need the mic. Is it working?
Yeah. Okay. And then, you know what, we should probably, we'll start over once we get the microphone.
Okay.
Apologize, Oscar. It's the new world.
Green mic.
Test. There we go. All right.
You can start over.
Okay. All right. Thank you, Investment Committee Chair Prezant and other members of the committee. My name is Oscar Cordaro, and I am a pet care specialist at a PetSmart in Casa Grande, Arizona. I'm a member of United for Respect, and PetSmart workers have been communicating with CalSTRS for over a year because of your €259 million commitment to the BC Partners Fund that purchased PetSmart in 2015. I have worked at PetSmart for almost 3 years now. In those 3 years, I have experienced firsthand the understaffing and meager wages PetSmart and BC Partners have to offer. My biggest challenge is staffing. Associates who remember the old PetSmart say staffing was more than adequate, before BC Partners cut critical positions. Usually only one associate is scheduled in my department. This means one person has to feed and water every animal, medicate and observe the sick ones, and clean the assigned fish tanks and sales floor cages, with only, on average, 90 minutes before opening to get all this done before customers come in. And once they do, the single pet care associate has to help all of them with catching fish, scooping crickets, boxing up animal sales, all while finishing any tasks they were unable to complete before the doors opened. On Sundays, it's even worse, as we only get a mere 30 minutes to do everything required that day before customers arrive, and sometimes it takes the whole 30 minutes to do one task. Needless to say, the stress is immense. I have often had to take a 15-minute break to cry in the break room due to how much I have to do. And I know the stress is getting to many of my coworkers too. I struggle when I can't finish a task I have started, and being the single person working in pet care means I'm being pulled in 3 directions at once. There's also the issue of wages. When I started, I only made 10 cents over minimum wage, which was $12 at the time. And with being part-time, I didn't make enough. I turned 26 in 5 days. I will not have health insurance this time next week. And since I only get $14.51 an hour right now while working part-time, most of any future paychecks could go towards paying that premium instead of other essentials such as food and gas. It worries me, especially given my family history of severe chronic illness, that something may happen and I won't have coverage when it does. We are here today to ask CalSTRS to reach out to BC Partners about the unaddressed issues PetSmart associates are facing. The New York City Comptroller's Office helped secure a meeting between BC Partners and PetSmart workers. And if more pension funds call on BC Partners to meet with workers and find solutions to the issues in stores, we believe the private equity firm will engage more productively. We are hopeful that CalSTRS trustees and staff could encourage BC Partners to meet with workers regularly, at least until there's real progress on one primary issue. Thank you for your consideration.
Thank you, Oscar.
Thank you. Our next speaker will be, Doug.
That was quick. I was expecting the usual 30 minutes of people talking. So my name is Doug Orr. I'm the chair of the Retirement Policy Committee for the California Federation of Teachers. And is this not working? Everybody's looking? Okay. At yesterday's meeting, there were lots of people praising Betty Yee, and I thought it just needed to happen again today. So you're going to have to suffer through it one more time, Betty. So CFT wants to thank you for your years of service, both to the people of California and especially the teachers of California, because you brought decades of understanding of how the financial market works to the board. And as people were saying yesterday, you were very quiet, you were very calm, but you were always guiding the board through choppy waters, especially when it came to things like ESG. And so, as I said yesterday, you were instrumental in trying to increase the diversity within the organization and with the external managers. And especially, you've been incredibly good at guiding the organization when it comes to climate change. And so I just wanted to again reiterate, for those who don't realize it, that Betty is in fact an international leader, not just a leader in the state, but an international leader on addressing the issue of climate change. And people in California should thank her for that. People around the world should thank her for that, because she's had an enormous impact. And I'm pretty certain that in the years to come, she's going to be a little bit sad that she's not sitting on the dais to watch all of the positive things happen that she has initiated as a member of the Investments Committee and as a member of the Teachers Retirement Board. And having said that, praising Betty, I want to praise the entire Investment Committee, because you have been leaders in addressing the issue of climate change, even though a lot of the speakers who are normally at this microphone accuse you of not doing that. But all of you on the Investment Committee have been leading internationally on how financial markets can address the issue of climate change. So for all of that, I want to thank the board. I want to thank Sharon and Harry and everybody else on the board, and especially Betty. Good luck in whatever you do in the future. Thank you.
Thank you.
That's the conclusion of our public comments for item 2.
Thank you very much. The next item of business is the Chief Investment Officer's report. Chris?
Thank you. Before I go through the slides, there are a couple of comments I want to make. Normally, October is a fairly scary month for all of us, but this October, we had a spooktacular market. I'll stick to my day job. But to my surprise, that was somebody else gave me that. Okay. To my surprise, risk assets rallied, which is really shocking to believe. Developed markets, stock markets around the world rallied. The U.S. equity market was up 8%. That's what we expect in an entire year, but just in 1 month. Emerging markets were actually dragged down, mostly at the end of the month by the Communist Party Congress in China, and the sort of crackdown on their equity markets. Treasury yields climbed. Remember that bonds are a teeter-totter. So when yields go up, prices go down, then the other way. So as the Fed has raised interest rates, prices and the return on fixed income drops. Real assets, which are just physical things, actually went up in value a lot last month. And then for the first time in 5 months in foreign currencies, FX markets, the US dollar finally weakened. It is still super powerful when you go overseas. I mean, we're at a premium to the euro. So the euro is worth like 98 cents to the dollar, and amazingly close to parity on the pound. Kirsty will tell you she is very depressed, but now she's powerful when she goes there. So it was such a good month. This chart shows back to September. We were almost all the way back to break even at Halloween. In fact, the fiscal year to date return on the fund was only less than a negative 1%, 0.8. So really remarkable. When you look at the asset allocation, it looks like we're overweight growth. We're actually basically neutral. We're underweight public GE, global equity, but then the weighting of private equity makes it look. But look at the next two bars. We're actually kind of 50-50. We're 50% growth and 50% diversifying real assets. So very balanced in here, which is helping the fund in this kind of a turbulent market. This chart, if you look at the deep blue, royal blue, that's where you can see the decline over the last 3 years in private and public equity, partly because we're investing in other places, but also because we've been taking it down, using it for cash flow and then other purposes. So that really, more than the other chart, shows you the diversification of the fund and how we're really probably 50-50 in risk mix. I don't need to say that inflation's running higher. This chart goes all the way back to the 1980s and 70s, so that's really the last time we saw inflation at this level. It may slow, probably to 5% here in the next, say, 2 quarters. That's still too high for the Fed. They want inflation down to 2%. So there's a lot of talk about what's the resting heart rate for inflation, and that leads us to interest rates. What's the resting heart rate for interest rates? So even this graph is out of date from just a week ago because the Fed yesterday raised rates 3/4 of a point. So picture that whole thing shifting up even higher. I didn't look this morning, but yesterday T-bills, 1-year T-bills were 4.6%. So you're earning money on your savings accounts for the first time in feels like almost 2 decades. The 30-year bond was at 4.1, so there is still that negative slope from 1 year to 30 years, about 50 basis points. And as we've said before, that tends to portend a recession. So we're going to keep watching this, but we think, and now the Fed has made it pretty clear, they're going to go all the way up to 5%, maybe higher. So we'll just watch that curve ratchet up on a regular basis. This chart was fun, but unfortunately it's out of date because it doesn't pick up October. But it shows you that the 3-year returns are very different than the recent returns. We still had such a positive year before. So let me climb up the crow's nest and look out on the horizon. The big question out of all of these is recession. You hear that all the time. A big question of when is the recession and how bad is the recession? An old adage is that economists have predicted 9 out of the last 5 recessions. Cute joke. In other words, they overestimate recessions. But what Scott and I picked up in our trip to New York last week is 100% of the macroeconomists are predicting a recession somewhere between now and in the middle of 2023. That consensus is affirming, yet on the other hand, like the joke says, economists tend to be wrong about half of the time. So we get very worried. I get very worried when everybody agrees on one point of view. But the bottom line, if you listen to Jay Powell yesterday and his words he used, he reiterated what he said since August at Jacksonville, Wyoming. He's going to fight inflation, and if he has to hurt employment and the economy, he will. So we'll have to sit back. We heard it in the last slide, the inevitable risks. We heard it at the offsite about just the numerous amount of risks. If I look at this chart from when I created it, obviously I'd bump up North Korea. You heard this week they launched 10 missiles in a day. And then I can't believe I'm saying this, but the likelihood of a radioactive bomb, either a dirty bomb and I never heard the phrase tactical nuclear weapons, but we have to recognize, that probably lands as unimaginable as it is. It may land as an inevitable surprise that is a threat that's out there. So with that, I'll open it to questions.
Any questions from the panel?
Devastating news.
Yeah.
It was a good morning. Betty, I know you, if this is your last investment committee meeting of this year, maybe there'll be a future year you'll be back, hopefully. You've always led us in asking the most meaningful questions. So I'm going to see how good you are on your feet with an extemporaneous request that you ask the first question.
Thank you. Thank you, Mr. Chairman. Sobering report that not really questions, and I think we'll cover it later on in our agenda, but certainly with what Chris just outlined will have us digging deeper in terms of where we see opportunities, and certainly we know that we continue to do our work in a riskier environment. And I think maybe the one question I have is just with the high inflation risk, whether this has really affected our credit investment opportunities in any way.
It has increased our credit opportunities because what we're seeing in the debt markets is higher and higher yields, so we're getting cash flow. But you've got to keep in mind that companies have been operating for almost the 2020s, and into the 2010s with very low interest rates. So their debt structure, as you get lower in their debt structure, they have to have a higher interest rate. But that interest rate was only like 4 to 5%. Well, now it's 9 to 10%. And so there's a big question out there as the Fed keeps raising rates. If they're really going to go past 5, then companies are going to have debt structures that are closer to 10 to 11 to 12 on their high yield. Can they survive at that level? And that's part of what's built into this recession model, is that by raising interest rates, all the people with variable rate debt really get squeezed and will not be profitable. Inevitably, there will be some defaults, but the difference this time, because so much of the debt is private, what typically happens then is a negotiation. And if you remember the phrase we used to use in real estate of pretend and extend, when people can't pay back their debt, the borrowers usually say, okay, look, we'll extend your loan, we'll add some more covenants, but we'll pretend that you still can and give you time. So I don't know how many outright bankruptcies we'll see, or really just restructurings. And We're already starting to see that with some of the tech companies and some of the, well, I hate to say it, my favorite indoor cycle, Peloton, is a good example of a company having to restructure, having to change, and extend to buy time. So, but for us in credit, there's no question, credit analysis and that deep dive is critical.
Yeah. Thank you.
Karen.
Okay, I get to ask a really crazy question again. Chris, on your last page of your report, I always look at this one because I'm always worried about benefits that are being paid out. And so when I compare the figures for this report, I look back at July 22 and it was 129 months. And then August 22 was 123 months. And now it's 106 months. So is this a trend? Do we worry? Is it a comfortable cushion?
No question, it's a comfortable cushion. Cash flow is one of the first things we look at when we talk about the asset allocation because we have a slightly negative cash flow. And David Lamoureux tells us it will get more negative as we go back to a maturing fund. So it's no question something we watch. It ebbs and flows based on how much available cash. Summertime is always a dry time. While teachers work, we don't get a lot of contributions. We pay out more in benefits. And then just due to our asset allocation, we had capital calls on our private investments at a time where we weren't getting a lot of dividends and income. So it's something to always monitor. We like showing it, but we have more than ample cash for all the benefits for an extended period of time. And, when we look at that, we're looking at cash and then tier one, which is highly liquid assets. And always within the plan, over half of the plan is in what we consider liquid markets.
Okay, thank you.
That was a very good question, Karen. I know that the benefit receivers of this organization are happy to hear this answer as well. Any further questions from the board? Is there any public comment for this item?
There are no members of the public in queue.
Thank you very much. All right. Our next item is the annual investment cost and savings report with April Wilcox and Shifat Hassan and Michael Dunnigan. If I could just make one comment before you start, I thought the presentation that you provided was very understandable and encouraging. Thank you.
All right, so April Wilcox, Director of Investment Services. With me, Shifat Hassan, Head of Investment Performance and Compliance, and Mike Dunnigan, who's Associate Portfolio Manager. So I am very pleased to introduce another year of our annual cost report and our collaborative model savings report. We're going to introduce and present both of them together this year. And we've been doing the cost report for over a decade. This is our second year of the collaborative model savings report. But in the report, there's data back till 2017, so you can start seeing some trends this year. We are always continuing to enhance the report. We actually have a number of items we want to add to next year's report already that we're talking about. But for this year, we've added several new things. On the cost report, attachment 4, we have added operating expenses broken out by asset classes. We've also expanded the capture ratio to include all asset classes. And we've added more analysis on trends of costs. So you can see all of that in the cost report. I wanted to remind you all that this is staff's report, but we did work very closely last year with Makita on the scope and methodology of the collaborative model savings, and it remains exactly the same this year. So with that, I will pass it off to Shifat.
All right. Good morning, members of the board. April, thanks for the intro. I'm going to jump right into the numbers. On the screen, what you see is your basis point costs for the last 7 years. your total cost out the door for 2021 was a little over 88 basis points. Now, we generally look at cost in two very broad categories. So the green bars are the carried interest that move with returns. And the blue bars are the costs that generally move with AUM. Although we want to see the green bars higher because we want to see more returns, we want to contain the blue bar. In 2021, your total cost without carried interest was 54.4 basis points. Now, what does that mean? It's not easy to bench that number because there is no another CalSTRS, but we can do two things. We can compare ourselves with other peers our size, which we'll do later in the presentation. And we can also compare ourselves with the past years. So if you look at that number, the 54.4 basis points, and if you look at past years, 2021 was a really good year. And that goes to show staff's efficient management of costs. That goes in line with your belief 3. So these were the basis points. I'm going to pass it on to Mike. He's going to talk about the actual dollar cost and the attribution of those costs.
Thank you, Shafat. So as we move to the next slide, we want to talk about the overall investment costs in dollars. And when we do that, we actually want to break out what were the drivers of the change in costs from the prior year. So Shafat mentioned that our portfolio costs in basis points, which is relative to the NAV, actually decreased. But when we look at them in absolute dollars, they increased. So the reason for that is because we actually have the variable portion of our portfolio costs, which are management fees. So these management fees are tied to net asset value growth, and that's going to raise as our net asset value grows. Now, if we break down the drivers, you can see because of that net asset value growth, 29% of that increase in cost came from the NAV increasing. We had a wonderful year in 2021. We went from $260 billion on average to around $330 billion on average. That increase, our NAV grew, our management fees grew, and that's where most of the costs increased from. Now, our asset allocation, though, has been increasing over the past few years towards a higher allocation to private assets. But in 2021, that actually flattened. So if we go back to the other slide for 1 second, if we look at the blue bars, those are our portfolio costs. And you can see from 2016 through 2020 that when we strip out the effect of the net asset value, that our basis points continued to grow, and that was because we were increasing our allocation of private assets, which are more expensive, and that's where that cost came from. What you could expect, though, is that when in 2021 that flattened out, that we would see the expense growth flatten out. But instead, as you see, we saw a dip. We saw a decline in our costs. That decline is what we attribute to the collaborative model. So the collaborative model has two components where we achieve savings. The first part is really an economies of scale portion. So we have operating expenses that are more fixed portion of our portfolio costs. Those aren't going to appreciate in the same rate as the net asset value growth. So we got about 1% from that portion. But the bulk of this actually came from our collaborative model, from our allocating more to private assets, and while doing that, we continued to shift towards co-investments where possible. So in 2021, where our private asset allocation didn't even change at all, we actually increased our allocation to co-investments. So we added over 50 more co-investments, and the value of those co-investments grew by $5 billion. So the combination of those two actually added 9% in cost reduction from the prior year, equating to a portfolio cost increase of 20% from the prior year. Now, as Shafat mentioned, carried interest paid, we look at that a little bit differently. That is the profit sharing component. It is not 1 year's accrual. We show this on a cash basis as it's paid. It includes multiple years. In the past few years on the private asset side, we have seen double-digit returns. So much growth. In 2021 alone, private equity returned over 47%, which is huge. So we expected to have to realize gains after a period like that. That's what happens when your investments go up. People want to realize the gains, and we have to share the profits. But our NAV, as you can see, grew in such a large amount. If we go to the next slide, there's a lot of data here, and I'm not going to go through it. I know you guys looked at it in the cost report. Really just want to focus on the right-hand side so you have a visual in numbers of the differences between internal and external and public and private costs. Those are the costs in basis points. So how many basis points per dollar does it cost? If we look at our internally managed public assets, they were 55% of our total portfolio, but they were only 3% of the costs. They cost 3 basis points per dollar to actually run that side of the portfolio. But that, in contrast to private assets, you might say, hey, that's a huge difference, and it is. But to have a balanced portfolio, you can't just have one strategy. You have to diversify. You have to have different growth opportunities. So this is a totally balanced portfolio. These differences can actually be seen partially in the capture ratio, and that's what Shafat is going to go over next.
All right, so last year you asked us to make connections between cost and returns. We use the capture ratio to do that. It's difficult to match up costs for 1 year with a 1-year return because, like Mike mentioned, we report costs on a cash basis and returns are generally based on realized and unrealized. So in order to make this more meaningful, we look at a 7-year average, and we're going to keep building this as we go through the cost report in the future years. But I'm very pleased to report that in 2021, we reported the highest capture ratio ever, 94.1%, which means that we kept 94 cents of every dollar of returns. We also heard you discuss the opportunity set of collaborative model strategies. So what you see up on the screen is where those opportunity set is. Now, there's a lot of numbers, but I want you to focus on the bars. We will never be at 100% capture ratio because we'll always have some level of cost. But the goal really is to reduce the gap between the green and the blue bars and push those costs to go below and push your returns up to be closer to the gross returns. So as you can see from the slide, the biggest and largest opportunity set is within the private assets, specifically private equity, that has the biggest gap. But also these are the asset classes that have a greater absolute return. So just a view on where the opportunity sets lie. Right, and on to Mike for the peer comparison.
So the peer comparison, this is really the results of our CEM benchmarking survey, which is a cost effectiveness survey or comparison against our peers. So if we look at the graph on the right, the US public fund universe of public funds, that's a green line. That is where we have a size advantage to most of the funds, and we would expect to have lower costs. But it's that light blue line that's our actual group of peers that have similar sizes to us. That's where that size advantage disappears, yet we still have a lower cost. And to add to that, that peer universe, the bulk of the peers in that universe actually have a cheaper structure than we do, meaning they have more internal management than we currently do. And so you would expect that we would have a higher cost than them, but we don't. And you can see it deviated even further in 2021. And what this means is that we're actually paying less for similar services. And that's kind of that collaborative model mindset. It's an awareness of cost. It's more than just internal management, whether we're negotiating fees with our vendors, whether it's the transparency and the reporting that we do. The teams are aware of cost. They're always trying to add value. They're always trying to add return. And a portion of that added return is going to come from savings. So with that, let's look at how much we saved. Can we go to the next collaborative? We didn't do the collaborative model stuff in there.
It was in there.
Okay.
Why don't you just talk to it?
I'll just talk to it, no problem. All right. Sorry, everyone. So the collaborative model savings, and these graphs that we're going to speak to are in the report, but our actual dollar amount, oh, there we go. Yeah. There we go. So this is the collaborative model savings calculation. We've got 5 years now, and I mean, just take a look at the number. That's a huge number. $1.2 billion has been saved over 5 years. If we boil this down just to 2021, you can see it's $437 million. 290 of that came from management fees. 146 came from carried interest. If we look at the graph for how we've been tracking this, you see a trend of growth. We're increasing the amount that we're saving. And this is coming from, as we ramped up private assets, continuously going into collaborative structures where possible. I mentioned the co-investments rising, but collaborative structures as a whole are the reason that we're increasing this. There will be a point, there'll be an optimal mix where our management fees will still save, but it will kind of flatten out. And our opportunities for savings are always going to come from the carried interest portion. So This can also be seen in the return. So if we look at the return impact and we focus on the excess return added column, we added 16 basis points of return to the total portfolio. If we look at this by an asset class perspective, there are asset classes that pop out. Obviously, private equity, inflation sensitive, added 63 basis points and 67 basis points to their asset class returns. But if we view it on the right, every single asset class actually contributed saved dollars in this year. And that's a huge testament to all the asset classes working on this together. We see that real estate had 80 million in savings, fixed income, where almost the entire portfolio is internally managed, saved almost 60 million. So this added up to 437 million total for our savings for 2021. And with that, keeping it short, I'd like to turn it over for questions.
Thank you for the presentation, and thank you for the very understandable slides that you put together. It really first rate. Thanks. People like I am and others of us who are not experts, it really does help understand the impact of the collaborative model and the cost savings that it is promoted. First up is our chairman, Mr. Kiley.
Thank you, Mr. Prasad. Couple of questions. First of all, congratulations on a terrific report and a understandable presentation. I was on the board when this report was first requested, I believe, by Mr. Rosenstiel, and I've seen the evolution of it, so congratulations on that. So 3 questions, if I may. One has to do with what our expectation should be on a forward-looking basis around the ability to control costs, especially in private asset classes where there's so much capital chasing deals, and what our realistic expectation should be around controlling those costs on a forward-looking basis. And maybe it's for folks that are not presenting but are here.
So Harry, you had 3 questions. You do want me to go first or answer this one?
Yeah, why don't we go one at a time?
Yeah. So our expectations, and we as you know, if we go back 4 or 5 years, we were at 5% of our NAV commitments in a year in private equity or co-investments. Today, we're at 25%. We believe that we can get to 35% over the next 2 to 3 years. And potentially, we can continue to optimize the portfolio and move beyond that. So I think that, as Chris had outlined in the business plan, we aim to save an additional $300 million per year over the next 5 years and get to that run rate. We believe that's achievable.
Great. Second question has to do with how does the team think about, and how do you wrestle with what could be our desire to control costs, but ensuring in the attempt to reach that goal, we're not trading off opportunities and returns?
Let me jump in and take that question again. So we're going to discuss this in the closed session for Collaborative Model 2.0. But if you think about the cost savings, we're net return investors, right? So whatever structure brings the most value to fulfill our mission in securing the retirement of the teachers, we're going to maximize that value. A lot of times it is trying to deliver on the cost savings. But let me give you an example. When we are an equity owner in a business, we'd provided some examples where we were sharing in the revenues of a private credit manager. We had a certain percentage of that. So when they raised the fund, and one example in particular, we committed $250 million to their fund. They raised the fund, it reached $5 billion. So the value of that ownership stake was around $80 million. Then we're going to get the cost savings of having a $250 million co-investment vehicle alongside it. But the value of that ownership interest would far exceed the value of the cost savings, right? So we are making those decisions. What is going to bring the most value? Is it cost savings? Is it ownership interests? Is it a different structure? And that's the heart of the collaborative model, because we're open to a joint venture, ownership interest, co-investments, SMAs. And I think this area is our mantra is to become the global partner of choice. So we're working with our partners to leverage the most value for CalSTRS.
Look forward to more detail in closed session. And then final question, if I may, has to do with, this is a staff report, as you mentioned at the beginning, and you get some support from Makita. This report itself, given the numbers and the complexity of the portfolio, appears to me that that could be a job for the year to monitor this.
April's like, it is.
Yeah,
It is.
How should we be thinking about, additional resources and verification from Makita or someone else that might be helpful to you on future reports and also for us in our oversight role?
That's a good comment. A big portion of the report for the private assets is done by Mercer. And so they're actually here in the audience. And I think a couple years ago when we first started using them for the private asset part, they would come up and present as well. And so that really takes a lot of the burden off. And so then Mike and his team can focus on doing the analysis, pulling together the internal costs, and coming up with what you have here. So I think it is really a good partnership that we have with Mercer that gives you validation that we do have some independent reviews on it as well. And they look over all of it for reasonableness, as well as, Makita on the collaborative model part.
Thanks, April. Thank you very much, Mr. Chairman.
Betty, you're up next.
Okay. Thank you, Mr. Chair. A really wonderful report. I just really enjoyed reading it, and thank you for taking us back a few years as well, just to kind of see how we've evolved to this point. I had a couple questions kind of following on a little bit to Harry's question, and that is kind of the landscape in which we're now looking at the collaborative model and how we're moving forward with respect to the private asset classes, and then the focus on fee reduction. Probably more to Chris and Scott on this question, and that is how has the focus on fee reduction maybe impacted our relationships with partners, particularly in the private asset classes? And then the second question, I was just curious, and that is, as investors turn more to co-investments and other kind of hybrid fee structures, what does that do for more traditional LP fees? Are they likely to decrease as well because everything will just be more competitive?
Yeah, so let me take those questions, Betty, and thank you for the questions. Appreciate them. In terms of impact, I think that what I'm hearing from our partners is we've become a better partner because we are gaining a knowledge base that is similar to them, so that when they are presenting opportunities to us, we can react in a much more streamlined and nimble manner. And so it's not only the investment staff that I think where we've built expertise, and we've hired more experts within our private markets, but it's also just the whole organization. You recall the Pillars Project, as we endeavored to become the partner of choice, we realized that we needed to become very responsive to our partners, yes or no. Do you want to be looking at this deal or not, right? And so the reflection I get from our partners is we've really become a lot more responsive to them. And they love that because then, from their perspective, they only have 1, 2, 3, 4, 5 people that actually can respond in that manner. And I think that we've really differentiated ourselves from that perspective. So it's actually been a great partnership, if you will, and we've, what I get reflected back is that, that's making a big impact. And so it's sort of contra what you might consider, because you would think if we were looking for more cost savings that they would, but there's a win-win in the sense that oftentimes the capacity they have in a transaction one firm wants to speak for the whole transaction. So they need partners such as CalSTRS to respond with them, or it might go to another competitor, right? So there is a win-win in this cost savings. I'm specifically just talking about the example in co-investments. And so the second, I'm sorry, the second question you had was?
Just what you see happening with traditional LP fees, with this enhanced focus on co-investments, whether you'll see those fees decreasing as well to remain competitive.
Well, I would like to think that they would, but I've been thinking this for like over 20 years. So
You like it a lot.
Give me some hope.
I mean,
To make it happen.
I'm not exactly sure what the industry will do, but I'm pretty clear on what CalSTRS path will be, which is we aim to maximize the value for our constituents, and we're going to go out there and negotiate lower costs, or we're going to share with the manager. And that approach, I think, is very powerful. Will that eventually bring down fees in the industry? I guess colored me a little bit skeptical after 20 plus years. I'm not sure if it will.
Do you mind if I ask Makita for kind of their opinion on that?
I don't mind.
Okay, thank you.
Yeah, from my perspective, management fees for limited partners are less likely to go down because co-investments are now a bigger part of the industry. In some ways, private equity managers have used low fee or no fee co-investments as a way to reduce overall fees for their large partners like CalSTRS without having to reduce the fees for their smaller partners. So the world of large pension plans and institutional investors is migrating towards more and more co-investments as a way to reduce the overall fees. You still pay the same or similar management fee as a LP in the fund, but you get access to more and more co-investments, which reduces your overall fee load. So that's the current trend in the market. And like Scott, I'd be a little cynical about expecting fees to come down significantly, but there certainly is fee pressure across the board. So I think at the margin there will be demand for lower fees going forward.
Thank you, Steve. Thank you, Mr. Chairman.
Thank you, Betty. My Vice Chair, Gail Miller, please, you're up.
Thank you, Mr. Chair, and really incredible work. Thank you very much. I do hope the board, this capture ratio piece that you added is phenomenal. It's truly incredible when you look at how the savings work, and that's actually an improvement from last year to this year that the board asked for. So really, really well done. Thank you. I don't think there's anything like this really in any other institutional pension fund. So I don't know if one of you want to answer that just so everyone understands how spectacular this is in terms of what you're doing and measuring your colleagues. I think it's just really important to understand if anyone else is doing it. And hopefully one of the things we do as especially being educators is help other funds get to this place where we see more of this. So if you could answer that. And then I just have one small follow-up, or maybe Makita could answer that as well.
I'll jump in and then others can add. So we were recently at a conference where we talked about our report, this upcoming report. We've been doing this for the past 7 years, and I can tell you that it has become more of a trend now. In the past, what was easily extracted was the public market costs. The private market were the more difficult to obtain. So we've hired Mercer, like April mentioned, to get a handle over the private market costs, which is, I think, a great way to do it. And we have been talking to our peers about it because that's where I see most peers having a challenge to get a handle over the private market costs. Now, with that, I think since over the 7 years, there has been progress made. I think more people are collecting carried interest. But what I see where we stand out is we are also collecting partnership costs in the private market space, which is not very typical. So that is one thing that really differentiates us. We really roll up our sleeves and provide you a comprehensive cost report. Now, we have also taken it further, of course, based on the questions you've been asking us over the years. We have done the capture ratio. We've shared that with peers, and they feel it's a great concept. And I think slowly, one of our goals in the upcoming year is to talk more about our cost report. We'll add a link on our website so that people can easily access it. So Mike, myself, April will be talking more about it in the future.
Can I also add, like Shafat was mentioning, CalSTRS is sitting on the advisory board at the CEM and working with a lot of their largest peers and institutional investors to try to standardize the costs among the industry. And so we're very heavily active in that as well.
Just to quote Betty Yee, that's what I call leadership.
Yeah, thank you, Mr. Chair.
Is that it? Do you have anything else? Okay. Thank you, Gail. Karen.
Okay. Thank you, Mr. Chair. Thank you for the report. It's really, really good. I was focusing on just continuing the issue of the fees. I noticed that there's a mark in the chart that says quoted fee minus staff rate. And I know that I mentioned it before, but I just kind of wanted to get a better feel for how do you get the staff rate and so because if it's the staff rate, that's the internal money, right? And then that's how you would compare, and then that's how you would figure out what our actual cost was.
Yes. So
okay.
We actually pull all of our internal costs, and we look at salaries, travel, costs associated with running a risk system and trading platforms, and we combine all of that for each of the asset classes that do this trading. So specifically, if we're looking at a global equity portfolio that's internally managed, we'll take the salaries of the entire global equity team, add in some of investment services and people that help support them during the trade, add in, as I mentioned, travel and some other costs associated with trading systems, and build an average rate or a cost and attribute it as a management fee. So we build this average per dollar charge for all of those costs, the salaries, trading systems, et cetera, and then we apply it like a management fee. So to deduce the savings, we go out and we get a broker quote that said, if we were to run this portfolio and we wanted you to run it, how much would you charge us? Broker actually gives us a quote, and then we subtract our internal management fee that we've calculated from that, and that's how we achieve the savings per dollar and apply that to how big the fund is.
So it's the total of that asset class as a group, all the salaries and things like that. So it's not just one director or a couple of staffs.
The average group for all of the assets they manage and a portion of all the staff that support them. So that includes a portion of Scott and Chris and everyone else. So we kind of throw that all in there, get a number, and get an average per dollar. Yeah.
Okay. All right. Thank you. Thank you, Mr. Chair.
Thank you, Karen. Sharon.
Thank you, Mr. Chair. My question was similar to Gail's. Just reading this report, and I was around with Harry at the beginning of this, cost report, just to see it evolve over time. And I am really interested in us moving the industry, obviously, towards helping the little guys, honestly, to your point, Steve. I mean, we all know that CalSTRS and other large funds we are able to have that negotiating because of our scale, but to be able to help a lot of other institutional investors out there just to drive the culture of fees to be a bit more, reasonable, I would say. So I really love to hear that, your leadership at CEM. We get invited to go to a lot of, different places to present. And I just think, to me, talking about cost and fees is something I know trustees on a lot of pension funds around our country are talking about. So I just want to promote you and say, take those invitations, provide that leadership, because I think a lot of other funds need these tools. We're going to keep growing and evolving, but we should share the knowledge with others. The other thing I'd mention is I wondered if there's a way, and I know they have comms people, I see Teresa Schilling in the audience, that some of this, I know for our members, on the investment side, they kind of get, okay, we take active teachers, money every month, we invest it and get returns. But I do think a lot of our members are concerned about Wall Street and the corporate greed. And I think it is helpful to be able to have our members understand, like 94 cents of a dollar. That's a really, simple concept to understand. We're keeping 94 cents out of a dollar. That's phenomenal. I mean, that's an A in my class. That's 94%, right? So I wonder if there's some kind of communication we could get out to our members, whether that's, I don't know, in our connections or something, just a blurb about the cost savings and doing it kind of how we do that dollar and we split up the pension, cents or something. But to me, just knowing that, we're not, investment staff aren't on junkets all over the world or something. We're actually, monitoring these costs closely, and this money is being stewarded, thoughtfully, and we're tracking it and we're measuring it, to me is a really important message to get out to our members. So however we think about doing that, I just think, to me, I know if I were just, I am a rank and file member of CalSTRS, reading that would make me feel great about the stewardship of the fund. So I think the cost piece would be a great member education piece. So.
We can work with communications on that. We also created a one-pager front and back cost and collaborative model at a glance that we're going to work with communications on to put on our website under our report section, so it's easy to find as well.
How much I love videos.
Well, how much do you love videos?
There we go.
I have one question and just a comment. Thank you again for your incredibly informative report. The defined benefit, there are people out there that we hear always talking about, the defined benefit, we should go to the alternative, 401ks and all of that. What would be the cost for someone who has mutual funds in their 401k compared to the cost that we get with also the size we have and the ability to invest in private assets and real assets? What can you maybe comment on that?
Thanks, Bill. Sure, I'll take that question. So based on the research I've done, I think when we look at mutual funds and 401ks, there are layers of costs in there. But if you just take a pure mutual fund, in an active strategy, it's a single asset class, single strategy, your fees can be all the way up to 100 basis points. So that's the average that we are looking at in the industry. And if you compare that to CalSTRS portfolio, it is a multi-asset class portfolio, more complex. It has private investments, and our costs are about half that.
Thank you. And then the one comment about being the partner of choice. I think that a lot of that has to do with the quality of the people we have. And the reason we have quality people is because we're a purposeful organization. We're here to pay benefits to retired teachers so that they have a dignified retirement after working hard and consistently over the years. And I think that message has gotten across to many of our sponsors that we invest with. Just last week, I was with Chris and Scott in New York, and we met with some of these investors, these sponsors, and that came through from many of them. And when they seed a fund, like one of our partners has, they like to have us in there because it's a halo effect. Not only because we're a good, strong partner that is knowledgeable about the landscape, but because we have a purpose. And so they can attract more capital. And so we get the benefit of that. And I just want to acknowledge that for the entire team, the entire organization. We're very lucky to have that help make us the partner of choice. So anyway, I just wanted to make that comment. Thank you very much for the report. So the next item up, any other questions before we go to the next item? Is item number 5. Oh, excuse me. Any public comment on that item, this last item? No public comment? Okay. I sometimes forget to do that. So item number 5, investment policy and management plan, Geraldine and April.
Good morning, Geraldine Jimenez, Director of Investment Strategy and Risk, but I wouldn't mind being Shafat. I admire her incredibly, but I am Geraldine. So we're pleased to bring to you today an item that's been on our minds for a while. A couple years ago, we brought all policies and asset class policies, and we updated them. We're bringing forward the main core policy of the board. We call it modernization. It really is just streamlining, bringing a high level, more of a strategic view. We'll be rolling this out very slowly to make sure you're comfortable with where we're going. You'll see a mapping there. But I want to point out a couple key points. We're not deleting any core components of your policy. They will remain, and again, our slow rollout will ensure that you are comfortable with that. We are keeping them, and in particular, our ESG beliefs and goals, our diversity and inclusion, and our low carbon risk and opportunities component and beliefs definitely will not be lost. This has been a collaborative effort between, if you will, the investment side, my team, and April and Shafat and their team. So April will give you a few other comments.
All right, so as Geraldine mentioned, there will be only a few changes for streamlining and modernizing, and one of them is the name. And so industry standard right now is to call this type of document that's governing all of the investment portfolio, the investment policy statement. So after adoption later in the summer, this will no longer be the IPMP. It will be the investment policy statement, or IPS. If you look at attachment 1, you can see the framework of what is going to be added to this document. There's a lot of things that we're including. We're including table of contents, a preamble, and a purpose. The biggest takeaway in that is we're including the investment beliefs into the policy. As Geraldine mentioned, we're including sustainability to really reflect the board's pledge to net zero. We're including a summary of our diversity, equity, and inclusion and how that is related to the decisions we make in the investment portfolio. And we're also including a summary of our engagement and our divestment policy. So to again, repeat what Geraldine said, we're not changing anything that the board has already agreed to for these sections. We're merely putting it in the policy to really reflect our investment philosophy around it. We're also going to be including the funding level and how our investment policy relates to the funding plan. And we're going to be including expanding really the risk mitigation section and adding some more risk oversight to it. And we're going to be streamlining some of the procedural ALM stuff that's in the policy. So that is a high-level summary. We don't have a presentation, but if you look at attachment 2, there's a very nice graphic that will show you what is in the current IPMP and how that's going to relate to the investment policy statement. And so today is just information only, just to give you comfortable with the framework, the direction we're going. We'll probably be coming back in either January or March with just a first reading, just to give you an idea of what the new investment policy statement would look like. And with that, open the questions.
Thank you. Any questions? I think we're all looking forward to seeing a more streamlined and fashionable policy statement. Thank you. Oh, I'm sorry, Sharon.
That's all right. I just wondered if we could sort of, I don't know, make sure to emphasize or make sure we're integrating human capital or labor practices, that risk in the ESG language. I do sometimes think that gets a little bit lost in the alphabet soup, so I just would suggest that we make sure we integrate that language in there. But that's it.
The nodding of heads means agreement.
Well, do.
Great, thanks.
Any public comment on this item?
There are no members of the public in queue.
Any comment from our consultant on this approach, other than the ones you've made before?
I can confirm that the rest of the world uses the term investment policy.
So we do want to be fashionable. So, thank you very much. Very nice. Thanks. The next item on the agenda is the investment policy, procurement policy. Shafat and Stephen Tong. Hello, Stephen. Welcome.
And there's Mika.
And Mika, I didn't see you there. Thank you.
Good morning, Mr. Chair and other members of the committee. Today, first, before I begin, I'd like to give some introductions. So to my left is Shafat Hassan. She's the head of investment performance and compliance. And then myself is Stephen Tong, Director of Risk Mitigating Strategies. So today is the first reading of a new investment policy, and it has to do with the investment procurement. So this is a first reading, and just as a reminder, an information item. But you do have discretion as a board to adopt and approve. And if you do so, moving that, if you do approve the policy, it will become effective on January 1st. I just want to make a note that Makita has reviewed the policies and concurs with the staff proposed policy. So we want to go to the first slide. So this slide here, we wanted to talk about the collaborative model procurement pillar. And part of the collaborative model was there was pillars established we looked at many processes that need to be improved, and one was on the procurement side. The charter for establishing all the pillars as well as procurement pillar was in December of 2019. To oversee the procurement pillar, there was 2 executives that were assigned. So Lisa Blackneck was one, and Chris Ailman was the second executive that was assigned. And then in terms of the co-leading it, there was 3 individuals that were responsible for leading this pillar. I mentioned Shafat. Another individual I want to make note of is Suki Sahota. And he couldn't be here today, unfortunately, but he is the head of your procurement. And so, and then myself, so the 3 of us, we really co-lead this area. And what's represented on this chart here is just the different branches that were also associated. So it was really due to all the collaborative effort of all these individuals that really led to the success and where we are today. So I want to go to the next slide. And I want to, in this slide here, what we did was we listed all the individuals that actually were involved in some form or manner across the different branches within CalSTRS. So this really gives you a sense that there was many people involved, and if you count the number of individuals, there's 35 on this page here. And they're all leaders within their respective areas. So the question is, well, what is the results of our work that started back in December of 2019, so almost 3 years. So when we first looked at the existing procurement process, what we found is that on average, it took somewhere about 15 to 16 months to actually, from start to finish, get a investment procurement completed. And so our goal that we established, and this was set by the sponsors, Chris and Lisa, they said, well, can we get it down to 3 months? So the effort began with actually looking at what can we do to really and bring it down from 14 or 15 to 16 months down to 3 months. So we established really there's 2 deliverables. So the first part is that we looked at the current procurement process that has to do with contracting. And so Suki and his team, they went and looked at see what they can enhance. Happy to report that they were actually able to find significant time savings. So with their enhancements, that brought the process down to less than a year. And so what's really nice is that although this pillar initiative was established because of the collaborative model and for the benefit investments, really the whole organization benefits. So across the entire organization, the work that Suki has done on the contracting side will help all parts of CalSTRS. The second portion is on the investment side that has primarily to do with searching for investment managers and consultants and making the selection. Through that work is really, we had to go through Assembly Bill 539, which changed the ed code. It allows us now to kind of take the next step and think about how can we improve the investment side of the procurement effort. And so I want to now turn it over to Shafat, and she'll talk a little bit more about what's going to happen next.
Right, thank you, Stephen. So I want to jump in and talk about the governance structure of this policy that you have in front of you. On the screen is the hierarchy of how the governance structure would work. At the very top, you have this assembly bill that has passed, and now we are in the second step, which is the policy that you have. It is a delegation policy. What it does is the law allows you and asks the board or gives the board permission to form and adopt policies and procedures. And this policy, if you adopt it, will allow staff to create procedures and guidelines around a new procurement process. There's three takeaways really I want you to kind of focus on from this slide. One, this governance structure is not new. It's the same governance structure that you have for your other asset class policies. So investment policies, this is the ideal structure of how the governance works. The second takeaway is that the policy that you have is really principles-based. It calls for a competitive, open, fair, prudent procurement process. And the third takeaway is that that's really not very different from the spirit and intent of the current state procurement process. So it preserves the intent and spirit of the state's process. So I head up investment compliance, so I have to talk about the control framework. On the screen, really quick, you see this is the control framework. This is how it is today in the current process and will continue into the new process that we're proposing. One thing I want to call out is the business areas, investment services, procurement, we all work very closely with general counsel as needed to make sure that we are adhering and following all regulations and policies across the branch. And of course, Cheryl, as with every other process in the organization, Cheryl will audit the process on a recurring cycle. Last slide, in the agenda, we did call out several benefits of this policy, but I want to call out two. Expanded manager universe. This policy is really going to allow us to expand and cast a wider net of the types of firms we do business with. If you think about the current process as an inverse funnel, it's taking in really a small number of people and really asking them to provide a lot of information up front in the front end. With the new process, we are trying to flip that. We are trying to fix the funnel. We'll cast a broader net and only ask the high potential to actually go through the due process and due diligence. The second benefit I want to call out is very near and dear to all of us, being the partner of choice. So with an efficient process, we really can pose ourselves as the partner of choice. You'll hear Scott say this a few times. It gives us access to the best transactions, attracts the best business partners out there in the industry, and of course, it enhances the reach of this competitive process. So that was the last slide. Before I close, just to reiterate what Stephen mentioned, this is a consent information item. If you don't have any feedback or edits, staff recommends that you take action. Sure.
Anything further?
Yes, so General Counsel recommended that I add a quick note on the DEI component of this. So as part of the benefit of expanded manager universe, we feel that big as well as smaller firms will now have an equal opportunity to put their name in front of CalSTRS. So the process being so simple, we'll have a database where it's a simple intake form, so anybody can actually put their name in and get it to CalSTRS.
Okay, Chairman Kiley, you're up first.
Thank you, Mr. Prasad. Appreciate the presentation and the effective communication of what this policy is ideally supposed to do. So my question has more to do with looking forward. How do you think about us making sure that this policy, when it's adopted, that there's enough time that has gone by for us to evaluate that the results of this policy actually are as intended, and if there are any unintended consequences that we're made aware of those? Thank you.
Great question, Mr. Keeley. Definitely something that we have discussed extensively internally. But I will premise this is a new process for us, and we will be very closely tracking KPIs. And if this board desires, we can come back in a year's time and report the experience we have gone through.
Great. I'll defer to the chairman and the vice chair of the committee to work with the team as to what the appropriate oversight and evaluation of this change is, because I do think we do want to monitor it to ensure that it's working as intended, and if that there are any unintended consequences, they don't outweigh the benefits of this change. Because on its surface, it sounds terrific, and you can clearly see how this links to what we're trying to accomplish. So fully supportive of the direction, but I'd like to have at least initially some monitoring at the appropriate time that it's working effectively. Thank you, Mr. Chairman.
And Gail, we agree that we'll continue to, once adopted, we'll continue to monitor it and have reports, on it to the board or to the committee. Thank you, Harry. Good suggestion. Karen.
Okay, thank you, Mr. Chair. Thank you for the report or the perspective project. I was trying to think a little bit farther, and once in the guidelines that you say something about the final selection will be posted on CalSTRS.com. So what does that look like? What do you intend that looks like? So if somebody goes on CalSTRS.com, what are they going to see? What are they going to look for? Is it going to be in a certain category, or, I'm just curious.
That's something, Karen, we'll hash out as we go through and adopt the procedures. But in current process, there is a publication. Once we make a selection and award a contract, it actually goes into a website. And this process is no different from that. So we'll continue to do that.
Mirror that?
Exactly.
Okay, thank you.
Thank you, Karen. Michael Gunning.
Thank you, Mr. Chairman. I guess my question is the flip side of Harry's, which is what was the necessity for the bill and what are we trying to fix that now we want to measure later?
Yeah, so when we implemented the collaborative model, and one of the things we were trying to do is not only in the procurement side, but across all the different support services, such as travel, hiring, et cetera. We were trying to improve the efficiency. So one of the things that's really important in the investment side, when we try to secure investment managers or consultants, is really the timeliness. So we had a baseline where we looked at, I said earlier, is that on average it took about 15 to 16 months. So we were challenged and said, well, if we're going to implement the collaborative model, we want it to be successful. What we needed to do is to improve that timeline. So we set a goal of roughly about 3 months. And so it goes to some aspect what we think about as opportunity costs, and that was really the genesis. And so when we think about opportunity costs, if there's some investment opportunities out there, what we want to try to do is actually is to be able to make a decision earlier rather than later. And
So does it help you, once you've identified a manager, secure that relationship quicker and not lose the opportunity of the investment?
Yeah, it goes back to what Shafat was mentioning earlier about sort of their current process. So their current process is that we're asking a lot of information and then it's going through like this funnel. We're actually kind of flipping that upside down now, where we're building this. What we want to do is have create the ability to collect information early on, but not make it cumbersome for all the managers or consultants that want to do business with CalSTRS. So we're building this website to collect basic information. And so we'll have the information available to us. While it's being posted, we'll be able to monitor who is interested in doing business with CalSTRS. So we get a general idea. So it comes to the point that we need to secure services. We can actually source it from the database.
So going forward then, does the measure become the returns or the number of new investments we've been able to engage with, or both?
Yeah, what our envision is that we will now have a broader opportunity set to draw from. But the process of actually the selection and the evaluation basically stays the same.
Thank you. Thank you, Mr. Chair.
Controller Yee.
Thank you, Mr. Chairman. My question, I want to align with Mr. Keeley's comment about just an evaluation component to this. So I appreciate that getting incorporated. I just wanted to say the policy is consistent with another policy I've seen in this realm, so I'm very comfortable with it. And to the extent this is a first reading, might it be appropriate to entertain a motion to adopt it so we can move on to the next steps of developing the protocols and all the things that we've talked about today?
We have one more questioner, but I'm totally in agreement with that.
Okay, thank you.
Thank you, and thank you for the report. And I'm also highly supportive of this with the additional understanding of how it will be implemented with KPIs on monitoring and the postings will be done as we've seen done before. My question, we could go to the motion, and maybe if the motion doesn't carry, my question would then pertain.
I want you to be comfortable. If you have
I'm 100% comfortable. What I was going to ask is if the motion is not carried currently, recognizing that we're in open session, recognizing this dynamic and challenging environment that we're in, if this gets pushed off by months, is there anything known on the horizon that we might be aware of will be more difficult to implement in the optimal way if we don't carry this today?
I can just generally answer that without, calling anything specifically out. But I think the more we delay, we're actually delaying a process that comes with all these benefits. And, Stephen mentioned the opportunity cost of, acting swiftly and timely in the investment world. So that's something that we will be delaying and putting off.
Thank you. I'm prepared.
Great. Is there any public comment? Seeing none.
No public commenters in the queue.
I know.
I have to listen to God. I have to listen to God. So I'm inclined, Ken, I'm sorry.
Actually, I was going to say without any further question, I'd move the motion.
I'll second.
So there's been a second and a motion and second. Any further comment?
Mr. Chair, do we want to hear from Makita or Mika?
Well, Makita, Mika, do you have anything to say about this? I mean, I read the recommendation that we got, but on the record, Makita has recommended we adopt this policy.
I don't have anything further to add, aside from the fact that simplicity and transparency are two objectives that I think we all share, and this policy, I think, moves you very far in that direction. So we support it wholeheartedly.
And thank you for your review of it earlier. Okay, there's a motion. There's been a second. Would you take the roll, please?
Controller Yee. Superintendent Thurman.
Aye.
Ms. Yamamoto,
Aye.
Mr. Tang,
Aye.
Ms. Hendricks, Mr. Keeley,
Aye.
Ms. Bradford,
Yes.
Ms. Erden,
Yes.
Mr. Gunning,
Aye.
Mr. Ruffino,
Aye.
Ms. Miller.
Aye.
Chairperson Prezant, do you care to vote?
Yes. Thank you.
All right, your motion passes.
Well, that finishes us just on time to take a break. So unless there's anything further, yes, Chris?
I just wanted to remind, we need to do a little audible on the agenda before we go to number 7 to do 8 through 11. Thank you. But you could take a break and then come back to that.
Why don't we, what's the feeling of the board? Would you like to deal with those now? Great, let's take a break, okay. When we come back, we'll come back here, and then we'll move on to the other venue, okay? Thank you.
Thank you.
We'll be back here at 10, how about 10:50?
You have to wait for the countdown.
Do we have to wait for the countdown? I don't think so. Once we, yeah, I don't think so. Before we take up item number 7, we've got a consent agenda action of item 8, which is approval of the minutes. Any concerns about the minutes? We'll adopt them as they are. Any objections? So the 2021-22 GIPS performance report. Any comments on that? Without objection, it's adopted. Information items, review of information requests. We've had none yet. There may be, we may have to come back to this. There may be some that arise in our discussions out of item number 7. So let's not deal with that at this time. Draft agenda for our next committee meeting in January.
Bill, I thought there was an information request related to the item on where you wanted to review the monitoring of our procurement policy.
Yes, and I think that's in the context of, and it's probably a suggestion from the chair to to Chris and you, that we have a regular report on the development of that policy, and not the development of the policy, but the impact of the policy as it's working.
Okay.
Draft agenda for the next committee meeting. Any changes or corrections? Without objection, it's adopted. And now we can, if Chris, if you and Scott could explain where we're going.
Yeah, we're going to move to more of a workshop setting. So we'll be moving right through the door to the room right next door. It puts us all on a nice level playing field. And the goal with this is to be very conversational. We do have some staff presentations and a consultant, but we really want to have just an open workshop dialogue to help us frame up the start of the asset allocation process. The next meeting, which is to approve that tentative agenda, is your first action step, and that will certainly be in public in front of everybody about which asset classes to include in that study. But this gives you a chance to discuss them and ask questions and just kind of have an open free-for-all. So we invite you to join over there. I'll turn it over to Geraldine and Josh and the team to really lead you through that opening debate and discussion.
Just to be clear, no action will be taken during this next agenda item. There will be just a discussion among board members of the items that might be considered in the asset liability management plan. So I think that's an important statement to get on the record. Brian, do you have any comment?
I just want to add, it's still open to the public.
Absolutely open to the public, yes.
But it's not live streamed.
Thank you.